Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about how the headlines on foreign and domestic issues are affecting mortgage rates. Before we jump in, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast. A very eventful morning.
Well, the theme that we always said the year was going to be like the show 24.
Right.
And yesterday we had on the verge of war with Iran, there's Mexican cartel fighting, there's going to be a huge snowstorm in New York. The tariffs are going to 15% now, unilaterally. And I was just like, I'm bringing my Jack Bauer glasses out, yesterday and going, all right, let's talk about economics. And then there was another big AI paper out there that the unemployment rate is going to go to 10% in 2028. And, so it was one of those days where, I thought about John Connor. You know who John Connor is?
Absolutely. Yes, the Terminator.
Well, I was just thinking when John Connor as a kid in the first Terminator movie said, hey, we're not going to make it, are we? And I was realizing he was talking about the labor market. It wasn't about anything else. Listen, when it all comes down, Skynet, they're going to do like these wealth taxes on Skynet. Okay.
That's how we're going to survive this.
Not going to love the wealth tax. And then people are going to attack the data centers. And there's going to be all these robots with skull faces. And we're like, we knew this was going to happen all the way back in the 1980s and 90s. So let's be careful of what we do with Skynet.
I know, this is so crazy. So we are recording this on Monday morning. And as of now, we don't have an invasion of Iran, but that could happen at any time. I mean, we have a lot going on. So, pull back a little bit and say, what are the markets? How are they reacting to this? What is the 10-year yield doing?
I mean, the last thing I saw was the 10-year yield was 406. I mean, it is really remarkable that also the John Hamm meme of, me dancing in the club, the bond market mortgage rates are like, whatever, Christopher Waller came out this morning and talked about, the March rate cut is a coin flip because he doesn't believe the labor market is recovering any. It doesn't really matter what Christopher Waller thinks. He's one of the few doves left. So it's got to be by committee. I mean, I don't believe there's any more rate cuts while Powell is in charge, but jobless claims is still historically low. So there was a lot going on over the weekend. The tariffs went from unilaterally 10% to 15%. The thing is that we're getting close to midterms, and it's going to be hard to have like a prolonged war with Iran. And, start doing, maybe too aggressive tariffs, going in. So like we've always talked about, it's hard here in America because we have 2-year political cycles. And you have to start putting in the midterm variable a little bit more every day that we get closer to that. And then once the midterm's over, if the Republicans lose one of the branches, things get more difficult. But very, very Terminator 24 show weekend with all the news and headlines.
I could use a little bit less drama in my life here.
Okay. But at least the 10-year yield's not doing anything, I mean,
that is true. So when you think about the war with Iran, right? So it's hard to know what that looks like. We went into Venezuela. That's a military action. Didn't really have anything to happen. Do you think that some military action in Iran, what does that mean for the 10-year?
If there is anything, it would just be limited strikes. I don't think there's any prolonged, tracted war here.
So you feel like how does the market react to that?
I mean, the oil prices have gone up a little bit, but if you look at the price of oil and you take away the highs of what happened after the Russian invasion of Ukraine and you just draw a chart line all the way down, it has these moves up higher. It doesn't really break out higher. So I don't know. It doesn't seem to me. Trump does these big shows with all these military aircrafts. He can do limited strikes out there. I don't think it's just going to be like a full-on invasion needing 80 or 100,000 troops down there. So they're probably going to deal something out in the next few weeks, and then the market moves on.
And, of course, so this is going to go live on Tuesday morning. Then we have the State of the Union, which we actually expect to have a lot of housing talk. We'll see. It might be overtaken by some of these other actions, but Tuesday night, right? We've got the State of the Union.
Yeah, Number one is there's going to be no more 50-year mortgage. So, I'm happy about that. Again, anything to help with supply is a good thing. Anything where we can get production of housing, good thing. I just think those things are like years out, so we'll see if there's anything about, maybe a short term, but if it's anything about production, it's going to take a while for that to have fruition, but it would be positive in that in any light. So it'll be interesting to see what they do. I know the White House and Pulte, whenever we do our updates with the spreads, where we talk about, well, mortgage rates would have been 720 in 2023, but now the spreads are here, we're at 604. So, they retweet that or show that. But in this case, the spreads kind of done their things since the end of 2023. We'll see if there's any announcements on that. But I know our Trinity talk that you and I had, was it November 7th, I think, the day after Trump won, is the three things Trump needs for this to work is a lower dollar, lower energy price, and lower mortgage rates. He, in a sense, has them all here, and there's still, concerns about affordability. So there's limits on how much lower oil prices or mortgage rates can go. We talked about that in the last podcast, that can you get 5.375 to 5.75? Yes, the 10-year yield went lower and spreads went lower if the labor data got weaker, stuff like that. But Fed policy is set on just only going to neutral right now. And there's all this talk about, maybe what can Warsh really do if they try to cut the balance sheet? That to me will be a little bit more interesting going out over the next few months. It's like, if they're really putting their weight on AI being disinflationary and cutting the balance sheet to maybe lower rates, that has to be brought upon in a clear message for the marketplace. But even Neil Kashkari of the Federal Reserve just basically came out and said, cutting the balance sheet aggressively is just not a feasible thing in the current environment, because they're just trying to back and forth with the banking system and the repo markets and all that stuff.
Outside of the, you mentioned we had big actions in Mexico too, right? So we have those kind of international things going on. Before those things, I would have said, housing is going to be, affordability and housing is going to be a main part of the speech. But now, I don't know, it might get crowded out too. But otherwise, I would think that there are some things they want to announce that are going to be like, hey,
you'll get announcement again. Announcements and getting things done, two different things. It will be interesting if there's anything on the builders. I think the White House clearly wants the builders to build on this land. The builders are, God, have you seen Logan's chart? Our completed units of sale are like at levels where we don't really push the pedal to the metal, guys. So we'll see. We'll have to take it one day at a time. There's a lot of theories out there. I question some of them. Some of them make sense, but we'll wait to see any of the announcements.
Yep. And everybody tune in to HousingWire.com. Obviously, we'll be covering the State of the Union. We'll have a story up shortly, and we may be doing right after it's concluded, and we may be doing live tweeting. So that's what we normally do during these things. So we shall see. So keep up to date there. Okay, Logan, weekend tracker.
Yes, weekend tracker, very positive. The weekly pending sales are back to the year-over-year growth. 2 weeks ago, we saw a good move on a week-to-week basis. We were like slightly below being flat for the year, but this week we went back to the earlier trend. You could really see the snow data melting away from the tracker in the sense that new listings data was negative year over year and not really growing much. In a normal situation, I would have been, okay, that's not a healthy thing. Like whatever we think about housing, we never want 2023 again. Like 2023, home prices were up 6%. New listings data didn't go out, and the seasonal bottom in inventory happened in April. If mortgage rates didn't get to 8%, we would have had that growth, toward the end of the year. But that was not a conducive housing market. But here, now that the snow data is fading away, new listings data picked up, weekly pending sales picked up. The price cut percentage is now down year over year more than 1%. So I think it is interesting that more people, as they read weekly data, are starting to figure out, like, why is the price cut percentage falling when there's these big declines in sales. Guys, remember, there's a holiday, and then there's the snow factor. So you wouldn't have the growth rate of inventory really slow down from what we had before if there was authentic like selling, right? So the new listings data was actually being held back, I thought, because of the snow, and now that's back. Weekly pending sales is back. Spreads are, on times when the 10-year yield goes down, the spread does go up. It keeps the volatility compressed, right? And that's why we're not getting much movement of mortgage rates. This is what typically happens. Again, very, very positive for the housing market that rates are lower and stable in this environment, because you can make better choices. You have more time to make choices on what you want to do when there's less volatility. And that wasn't the case a few years ago.
I think it was interesting to see that those positive data lines, because obviously we had a really positive start to, well, a positive start to 2026. And then we got hit with the snow, got hit with different things. And now it's kind of like, we're like, okay, yeah, that trend is held.
That's just so. Just remember that we're going to have one more existing home sales report that has that impact. And again, I wasn't a weather person, because to me the holidays, which we've talked about for years, which we said people are going to make overdeal because they don't track this stuff. Holidays, but the snow impact does fade away very quickly. The New York thing is just going to be a day or two. That doesn't really matter to the national market. But in general terms, it was good. It was good in that sense. Mortgage rates are lower, spreads are lower, volatility is less, inventory's up. Even though the price cut percentage is down year over year more than 1%, there's enough inventory to prevent prices from like having a 2023 year where they're up 6%. It is a very, very healthier housing market. Last year, I smiled really big because I thought it was healthier. This year, I'm smiling because if you want to try to get back to normal, these years have to occur, because you're not going to get, 3% mortgage rates anytime soon or anything like that. And you don't want to root for a recession for that to bring rates lower for a longer period. So I thought a very, very healthy tracker if you look at the data lines in context to what it was. And always remember, when you do have the holiday lull, you get this sharp rebound in tracker data, which is just a rebound effect at the start of the year. But all those things were at multi-year highs. Deal with the snow, and now new listings data picking up was really good. Pending sales picking up really good. And then we just kind of go with that for the rest of the year. But it's just so much healthier now than what it was a few years ago.
I also just think like it's amazing to me that we can have all these crazy headlines and it's like steady she goes, right? And that's what we need. We need less volatility in rates. We need the market to be, stable. And I think, I don't know, maybe we'll all just have like, it takes a lot to rattle things now because we've gone through quite a few crazy headlines.
Well, 65 to 75% of where I believe the 10-year yield and 30-year mortgage rate could range is Fed policy. So we have a lot of rate cuts in the system. We still have 2 more rate cuts technically priced in to the markets this year. And then mortgage spreads did their thing. So it looks normal to me. When I always highlight volatility compressing is a good thing. This is what happens. And it's just, we're so used to the last few years, mortgage rates would be over to 7.5%, and so we'd already see that spike. And what that spike does, it didn't crash sales anymore, but it didn't give it any leverage to go up higher in terms of demand. So we just have this back and forth. You just can't really operate when you have one rate's up, one rate's up. It's funny because in the last decade, one time in 2013, the 10-year yield went from 1.6 to 3%. The Fed tapered discussion, but I thought the economic data was getting better then. Mortgage rates went from like 3.5 to 4.5 or something like that. And everyone was flipping out because rates went at 1%. And like the last few years, like, hold my beer, man. That was nothing. You guys had it too good back then, but again, positive in the light. We'll take the tracker every single week. We'll look at every single economic data. We'll take all these crazy headlines. We'll try to make sense of it. But it's just like, it's interesting how everyone's like, man, there's not much volatility in mortgage rates, or the 10-year yield. We're just basically down here. And I was like, yeah, this is what it looks like. Now, if jobless claims had been rising, if we're heading up to 300,000 on jobs, then it's a whole different story, because the 10-year yield would be like, okay, it's finally happening. But not the case. Considering everything the housing market has gone through, this is as best as you could hope for with what's happening again. And part of this is there's a lot of people who are starting to think, the AI jobs thing is going to be real. And, over the next few years, it'd be very hard for rates to really accelerate higher if AI in theory was taking the jobs. But for now, the unemployment rate is low, jobless claims are low. The economy is still growing. Real final sales as a percent, as part of the GDP is still growing. So we'll just take it from there, one day at a time. This is why we're on 4 times a week. You won't let me be on 5 times a week. I say I'm going to be on 7 times a week, twice a day. Eventually, Logan wins. The Logan's run is keep on going, and it's going to be a lot of fun when that happens.
Well, you know what? I really appreciate you being on 4 times a week. And especially today when we were talking all weekend because, of course you did the tracker, but it was also like headline, all this stuff going on. I was like, okay, what's going to happen?
Like I said, you're my Chloe.
Oh, gosh.
And
okay, first of all, that's not really a compliment.
And what do you mean? Chloe was awesome.
The thing Chloe had going
the actress, loved my hair too, so that was a funny moment.
The thing Chloe had going for her, I definitely don't, which is all her technical skills, right? Like she's the one that could like hack into stuff. Like, come on, that is not me. So
Chloe eventually ended up running that little unit at the end of the thing.
True.
So there you go. So props to you. You're going to get a raise and a new title.
I'm not sure that I'm embracing Chloe on this. Jack Bauer, okay, I get it. I'll have to figure out somebody else. Anyway, Logan, thank you so much, and we will check in again very soon.
Pleasure.